Good evening, everyone. Welcome to this online forum brought to you by Bursa Malaysia and managed by LifeChamp. Today's our forum is titled Investing in ETF Risks and Opportunities. So welcome, everyone. Now, as you know, 2022 has so far been a bumpy ride for investors as we ride through volatility, high inflation, and rising interest rates. So globally and here in Malaysia, central banks are tightening monetary policy to curb inflation, and we are seeing that markets are transitioning into a post-pandemic phase that can bring both risks as well as opportunities. So can ETF really help investors in time of this market uncertainties? So today, we are very glad to have you join us as we discuss with our panel of guest speakers who will be sharing some insights into the global and also the local market outlook and investment opportunities using ETF strategies and why you should consider adding ETF in your investment portfolio. All right, so my name is Shane Choo. I'm the moderator for this session. So before we begin, just let me run through some disclaimer. So whatever I share on this online forum is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed security decisions. You are 100% responsible for all your investment risks. All right, so allow me to briefly introduce our esteemed panelists for this evening. So the first panelist is none other than Ms. Chong Lee Choo. So Ms. Chong Lee Choo is a director of ETF and Innovation Lab at Affin Hwang Management Bhd. She heads the ETF arm of the company and is responsible for the overall product and strategy planning for the business. As an avid believer in ETF, the company has garnered numerous awards for its ETF, including taking home the prestigious Best ETF Issuer at the Bursa Excellence Awards 2020 under her stewardship. Having worked with reputable banks such as Alliance Bank and Standard Chartered Bank, where she developed and managed products in the wealth management business, she brings with her over 15 years of experience in product development in the banking and fund management industry. The various products that she has launched during her tenure there had contributed to the growth of the wealth management business within these organizations. So welcome, Lee Choo. Our next esteemed panelist is Mr. Kamal Mustadza. He is the fund manager of Value Partners, responsible for research and portfolio management based in Kuala Lumpur. He joined Value Partners Asset Management Malaysia in April 2019. So Mr. Mustadza has over 9 years of experience in the investment industry, specializing in equity portfolio management. He was previously an investment manager at Social Security Organization, leading the foreign equity team. He also had stints with the Greater Eastern Life Assurance Malaysia and was a fund manager of Permodalan Nasional Berhad with a diverse exposure in managing funds in both conventional and Sharia space, with geographic focus ranging from domestic to regional. Mr. Mustadza graduated with a bachelor's degree in commerce, economics and finance from University of Melbourne. So welcome, Mr. Mustadza. Our next panelist is none other than Mr. Ong Soon Chong. Mr. Ong has more than 13 years of experience in finance management and investment research. He joined ValueCap Group in 2010 as Vice President in Investment Research Department, where he covered the Malaysian and ASEAN markets. He was designated as SVP or Portfolio Manager in 2015. He has a vast experience in managing various equity funds, ranging from exchange-traded funds, discretionary institutional funds, to ESG funds. His other experience includes various roles in an investment bank and Big Four accounting firm. So Mr. Ong holds a Bachelor of Accounting from Multimedia University. He is also a fellow member of the Association of Chartered Certified Accountants, ACCA, and the Malaysian Institute of Accountants. He holds a CMSIL license from the Securities Commission Malaysia for fund management. So welcome, Mr. Ong. All right, so maybe we shall begin this session by talking about exchange-traded funds, ETF, right? Maybe I can pose this question to Lee Choo. So Lee Choo, what are actually exchange-traded funds?
Hi, good evening, everyone. Exchange traded funds, to simply put, is actually generally a passive product where it tracks a particular index. They are usually called an index tracker, but however, it doesn't really mean that ETFs has to always be passive and track indices. I mean, in today's world, I think the very well-known ARK, Katie Wood and its ARK ETFs are actually examples of ETFs that are actively managed. So they work similar to a unit trust, but the only difference is that it's being listed. But generally, when we talk about ETFs, it simply means a product that gives you access to an index. Because today, let's say if you want to invest into FBM KLCI, you have to invest into the 30 stocks yourself, which is also, may not be practical. So what you can do is you can get exposure to the FBM KLCI via an ETF that tracks the FBM KLCI. So that's a very simple answer to that, Shane.
All right, thank you so much, Lee Choo. Anybody has anything else to add to that?
None from me. Yeah, I think
All right.
Lee Choo already covered everything. Yeah.
Okay, cool. All right.
Sweet and short and sweet. Yeah.
Yeah, excellent, Lee Choo. Thank you so much. So may I know what are the differences between exchange traded funds and unit trust funds? Like, which one should I choose if I'm new to investing? Which one should I choose, right? Maybe Ong can take this question.
Hi, good evening. Thanks, Shan. Thanks, Shane. And also, after listening from Lee Choo, let me just, show a comparison of, what is the difference between unit trust fund and ETF. Like what Lee Choo has mentioned, over the years, ETF has evolved, to very similar to unit trust fund. But in general, when we refer to ETF, we are still referring to what do we call a passive strategy investment. So let's look at it from a different aspect of it. First of all is the so-called fund objective. So in terms of fund objective, ETF in general will be a passive in nature. So passive in nature meaning which we actually track to a return of an index, and the return will generally be a broad market like FBM. Say if you talk about FBM KLCI, meaning which if you buy FBM KLCI ETF, you are basically tracking the returns of the index. So on the other hand, unit trust fund is active managed in nature. So the return is largely depending on the skill of the fund manager in trading, buying and selling. So this is the objective. And on the second aspect that generally when we talk about ETF is we're talking about the fee. As we all may aware that ETF is always a low fee. It's always low in the management fee. So it's ranging from 0.4% to 0.6% in general. Okay, of course they ask in the market they ask some that is slightly higher, some are slightly lower. But what it actually make difference besides the management fee compared to the unit trust fund is actually the sales charge or exit fee. So more often than not, unit trust fund will charge you up to 6% of the sales charges when you invest into it. And this is no such thing for no such thing when it comes to investing in ETF. So in summary, ETF is low in fee. So the third aspect that we would like to compare between the unit trust fund and the ETF fund on the trading part of things. Okay, so for unit trust fund, you can only buy it through the unit trust agent, and whereas for ETF, it is exchange traded. You can buy it as same as any shares that listed on Bursa Malaysia or any other exchanges. So and the investment amount for unit trust fund, when you want to subscribe to a unit trust fund, what you need to do is an upfront payment. Today, when you want to do a subscription, you will need to pay upfront, the whole investment amount. Then you will know the NAV price, at the end of the day. Whereas for ETF, just like what I've mentioned, the same as any listed shares, the settlement will be typical Bursa settlement T+2 currently. And also on the redemption also, when you want to sell off your unit trust fund, generally there are processing time. You may get back your money, T+5, on some of the unit trust fund. Whereas for ETF, still the same, it will be T+2, as per normal buying and selling. So this is in nutshell, this is how we differentiate between the unit trust fund and the ETF.
All right. Thank you so much, Ong. Kamal, you have anything to add to that?
Yeah, just a bit, because I think Ong has already covered most of the aspect of the differences between unit trust as well as an ETF and individual shares. But I think when we look at all these three instruments, the individual stocks, the unit trust fund as well as the ETF, we have to understand that it actually stands on different kind of spectrum. So from on one spectrum, you have the individual shares where you have to be more hands-on approach in selecting what stocks, the timing of buying and selling, and how much to buy and sell. I think it depends on the discretion of the individual investors. Meanwhile, if you go to the other side of the spectrum, if you go into buying into the unit trust fund, you actually kind of outsource those kind of decisions to the investment professionals, and of course, there will be associated fees that comes with it. So when we talk about ETF, it usually, in a way, a hybrid between those two end of the spectrum. So it is a hybrid between individual shares as well as unit trust fund. So I think, yeah, I think that's what I just want to add on that part.
All right. Thank you so much, Kamal, for adding to that question. So I think now that we have learned differences between ETF and unit trust, and also the differences in shares versus ETF and so on. So now, is there a trade-off between passive investing versus active investing? So is there a way for passive and active solutions to work together? Yeah, maybe Kamal?
Yeah, I think the debate about active versus passive has been going on, I think, for years. And of course, if you look at the definition of active, it is basically where the fund manager is trying to outperform the stock market return in creating the alpha. Meanwhile, for the passive, it is basically trying to track the benchmark. So basically, there's no right or wrong answer here. It actually depends on the individual investors or institutional preference on which type to choose. But I don't see them as cannibalizing each other. In fact, I do think that both passive and active can actually work together. So I think probably as an example, you can actually have an active approach using a passive instrument. So for example, let's say if you want to build like a global portfolio. So instead of buying individual shares from US, individual shares from Europe, from Malaysia, from China, you can actually just buy the ETF of different market, and you actually change the weight of each market index to actually reflect your investment thesis. So if you think that US is going to be the top performer, for this year, then you actually try to overweight the US market, and that is where the active part or active approach comes into play just by using the passive instrument. And I think similarly, similar thing can happen vice versa. I think like what Lee Choo mentioned earlier, I think like the active ETF, I think that's the example on how the passive approach to in a way an active instrument lah, because active ETF is kind of like, it's not really passive, it's an active instrument in a way. So yeah, I think definitely they can complement each other. Then it is not necessary that they cannibalize each other, but they can actually work together hand in hand. Yeah.
All right, thank you so much, Kamal.
Yeah, if I may add on to to Kamal's comment on this, referring back to the question just now also that we have mentioned about ETF is a very low fee investment instrument, and also you can trade it like any of the shares, listed shares in the market. ETF provide us with a very flexibility. You can go in and out easily. Just like just like in one instrument you can have the whole basket. Imagine if you have 30 stocks, like if you have a FBM KLCI, you have 30 stocks to buy, and to sell. It will be it will take some time and all that. But in one single instrument you can be in and out, and you can, that's where like what Kamal has shared, this is the easiest way for you to actively using this passive instrument for your portfolio.
If I can also jump in, I think the question is always, why is it that we have to choose? Why can't we have both, right? Why do we have to choose between active or passive? You should have both, right? You can have both if you want to. It's not like, you're choosing to get into a relationship with somebody and you just choose or stick to one, right? You can have multiple. I think I would say that there isn't any trade-off, but I think I would like to give a different perspective. Typically in the market as such, right, where markets are sort of going down, the downtrend, and whether or not we are sort of in a bear market, is debatable. But I think especially in times where the market correct massively, I believe that passive tend to outperform active. So if you want to look at timing, the reason for that is very simple. Active fund managers typically tend to protect the fund from downside, right? So in downturn markets, typically we will try to raise more cash and stay away from the market for a while because we want to wait and see, right? However, because given an ETF is structured in a passive way where we don't have an option but to be fully invested, when the market rebound, I think passive products will tend to definitely move faster than an active product like a mutual fund, simply because the fund manager, I mean, not to offend any fund managers here, but typically it could be slower for the fund manager to react because everybody is just, waiting for the bottom, and the bottom is really debatable, right? The bottom to you may not be the bottom to me. So in different market cycles, I think passive products do have a little bit of a upper hand. So as an investor, if you are sort of like balanced, have some exposure in active and passive, I think it would sort of help, manage your portfolio returns and risks.
All right, thank you so much to our three esteemed panelists who contribute to these questions. Now we know that stocks could be Sharia compliant or Sharia non-compliant. How about ETF? Are there any Sharia compliant ETF? If yes, what are these Sharia ETF available in the Bursa Malaysia market? Maybe Ong can take this question.
Yeah, in fact, from i-VCAP, we are actually a Sharia compliant management house. So yes, the simple answer to this is, like what all other investment instruments in the market, they are Sharia and conventional, and ETF are no exceptions. We have a Sharia ETF available in the market. The first thing is that, of course, the index that the ETF tracks, or the underlying of the ETF tracks, must be Sharia compliant index. And the secondly are the underlying securities. For Sharia ETF, it can only hold Sharia compliant securities, for the as the underlying, which are approved by the Sharia committee or Sharia advisor. And it is for Sharia ETF in Malaysia, it is very well governed by the authority, and they have to appoint the Sharia committee for the governance purposes, and not only the assessment of the Sharia compliance of their, and for the investment holdings is not only at the point when we do the investment, but it is also ongoing from time to time. It will at all the time that the issuer or the fund manager for the ETF will need to ensure that each and every single instrument or securities in the ETF, are Sharia compliant. So yeah, this is what we call a Sharia ETF. And currently there are 6 Sharia ETF that are available or listed in Bursa Malaysia. So 4 are the 5 are the equity ones, and 1 are the gold focus on gold. 4 ETFs actually issued by 4 equity ETF, Sharia ETF issued by i-VCAP, which is the My ETF series, and another one is by Value Partners on China, and another one, the last one that is on the commodity is Trade Plus Gold Trackers. Yeah.
Yeah. So all 3 of you have Sharia ETF lah.
Yeah, but Ong wins. He got 4.
Yeah.
All right. So give it to Ong for this question. All right. So okay. Maybe Kamal, do you have anything to add between Sharia and conventional ETF?
Yeah, probably I go, I mean, again, I think Ong has already covered most of it, but probably I go a little bit deeper when it comes to what we define what is a Sharia ETF. So basically, it is basically the ETF must be governed and it must adhere to the principle of the Sharia basically. So for a Sharia kind of fund or ETF, normally there's 2 parts of the screening. So the first part is the qualitative screening, of which businesses that do not adhere to the Sharia principle are excluded from the resulting index. So I think things like tobacco, pork, even the conventional finances are excluded from the Sharia screening. And then on the other part of the screening is the quantitative screening. So usually for the quantitative screening, there are different kind of methodologies being used. I mean, for Malaysia, we have the Sharia Advisory Council of the SC, the SAC of SC. At the same time, I think globally, the standard being used by the AOP, and also the standards being used by different index providers. And even between these different index providers, in terms of the quantitative screening, some using market cap and some are using total assets as the denominator in calculating all the cash ratio, receivables ratio, as well as the leverage ratio. So when it comes to the quantitative screening, I do believe, I mean, Sharia ETF does embed a bit of quality in it, because companies with high leverage are excluded. So in a way, I think when it comes to the period that we are seeing now, when there's a high volatility in the market, so these quality companies usually tend to perform better. So I think in a way, Sharia ETF do provide some kind of like outperformance against the conventional kind of ETF. Yeah, I think that that's pretty much it.
All right. Thank you, Kamal, for adding to that question.
Shane, if I can
Yes.
also do some advertisement.
Oh, advertisement, please. We love advertisement.
I think generally the Sharia compliant products for the equity market is quite clear, whereby there are fixed way of excluding companies that are non-Sharia compliant, right? Whereas for our ETF, because it's a gold ETF, so how do we comply to the Sharia compliance status is that, number one, the physical gold are in an allocated account basis. So that is one of the condition that we qualify ourselves as a Sharia compliant product. The second thing is that because gold is a ribawi item, right? So it has to be exchanged on the spot. So the fund also meets that criteria where, the minute we purchase the gold bar, the payment for the gold bar is sort of settled immediately. And then the other thing that we also qualify is the fact that we allow for the exchange of physical gold bars. So after purchasing, the gold ETF, you could essentially come to us and say that, hey, Affin Hwang, can I redeem my physical gold bars? The answer is yes. But however, you need to accumulate up to 500,000 units worth of ETF units before you can come to us to redeem the physical gold bar. So that will entitle you to close to about 5 kilogram gold bar, which is not a lot. It's just 5, the size of 5 iPhones. You just put in your handbag and then you can walk around. But it's probably costs you more than $1 million in the bag.
500,000. So if you buy
500,000 units.
Yeah, if you buy 100 units, cannot redeem. Okay.
Correct.
All right. So we have understood about Sharia ETF versus the conventional ETF. So the next, I want to focus. I want to bring the focus to liquidity. Now, as you know, liquidity is a typical requisite when we want to consider an investment, but not all asset classes are gauged the same way. So what actually determines the liquidity of an exchange traded fund? Maybe Lee Choo would like to take this.
Yeah, sure. I'm sure all three of us get this question the most. Every time we do a webinar or talks, the first question that the investors ask us is, are ETFs liquid? Why? Because the way to assess liquidity for ETFs is the same as how you assess shares. The truth of the matter is you can't actually assess ETFs liquidity just by looking at the trading volume of the ETFs. Unfortunately, in Malaysia, ETFs have not taken off in a big way, where every day you see a lot of trades going on and a lot of trading volume happening on the ETF front. So as a result of that, there is always this misconception that the investors had, where they think that hey, there's no trading volume. It means that if I buy it, I cannot exit. So that is actually a misconception. So how we typically would assess, bear in mind that ETFs actually have dual liquidity, right? The fact that this is actually a fund. If you are an institutional client, you can technically come to the fund manager and say that, hey, I would like to buy up, create a basket of the ETFs. And for as long as I can buy up the entire components of the index, theoretically speaking, the ETFs is liquid, right? So liquidity depends on whether the fund manager can buy up the components of the index. If the liquidity, if there is illiquidity in the component area, meaning if let's say I'm buying into say FBM KLCI, I'm tracking FBM KLCI, and for some reason, half of the FBM KLCI 30 stocks, maybe 15 stocks is non-tradable for, I don't know, whatever reason, then you can say that the ETF is not liquid because you can't sort of, purchase it or sell it if you need to. But otherwise, it's actually, relatively liquid. And furthermore, issuers like ourselves have the duty or obligation to appoint market makers to provide liquidity in the market. So they are the ones who are there to constantly provide you with the bid and ask price. So if you take a look, for example, at the LIP market, right? LIP market, sometimes for counters that are really illiquid, you see only one side, maybe the bid or the offer. But for ETFs, you constantly see that there is always a bid and there is always an offer. And some investors may not know, right? And they will be, thinking, why is it there's always, these two buyer and seller, but they forever cannot match? And the quantity is the same. So actually behind the scene, these are codes that are put in by the market makers to provide liquidity to investors.
Yep. I see. So if there is no bid and ask price, then it means that the market maker not doing the job, huh? So at all times, we should expect bid and ask in the market because there are market makers who are there to provide liquidity for the ETF. All right. So that's the main message I got today.
Yeah, I think so. Sorry, probably just to add what Lee Choo said. So basically, there's a saying, I think, in the ETF is that an ETF is as liquid as the least liquid constituent in the portfolio. So basically, like what Lee Choo said, if the ETF issuer can actually buy and sell the underlying that easily, then that means that the ETF is liquid already. And then when it comes to yeah, because we always get the question that the volume that you see on the screen is usually the reason why investors are shying away from ETF and investing in ETF. But we have to remember that the on-screen liquidity is just the tip of the iceberg. Again, like what Lee Choo mentioned, we have the underlying liquidity where we do the primary creation and redemption. And at the same time, I think like, again, what Lee Choo said, there's a hidden liquidity where you can actually go directly to the dedicated market maker to actually buy more if the current bid and ask cannot actually fulfill your demand. So yeah, I think that's just to add on the liquidity part.
Okay, so I learned that an ETF is only as liquid as the least liquid constituent stock in the fund. Yeah. All right. Yes, I think Ong, you had something to say, right?
Yeah.
I see you. Okay.
Yeah, just a quick one on just to echo Lee Choo and Kamal, that in fact it is a requirement for every single ETF to be listed on Bursa Malaysia to appoint at least a market maker. So be rest assured that when you see that there is not much trade there, doesn't mean that there's there is no market maker is there. If you really wants to wants to go in, you will notice that there are always both sides. You will see the bid and offer, and always there are ways for you to get more liquidity, be it primary creation or redemption, or get the help from the market maker. You can contact the issuer or the PD, participating dealer. They will be able to help you on that.
All right, so you cannot just look at no volume. Okay, so no volume doesn't equate to no liquidity. Okay, because there are market makers here in the ETF scene. Yeah, so that's something that we need to learn. So okay, let's go to the next question. Since we have understood about liquidity, how do investors use ETF to construct a portfolio? And is there any difference in the way that how retail and institutional investors look at it? Maybe Kamal would like to take this question.
Yeah, happily to do so. I think in order to be able to understand it better, so I think I'm going to share my screen.
Oh yes, please go ahead.
Yes. All right. So is it appear now?
Yes, it has appeared on my screen. All
right, awesome. So there's actually a various kind of ways for investors to actually incorporate ETF in their portfolio, be it from the viewpoint of the individual investors or from the viewpoint of the institutional investors. So I think the most simplest way is basically diversification through buying just a single ETF. So usually when we talk about broad market kind of like equity ETF, it is actually comprised of a number of underlying securities in it. So I think, for example, for our ETF that Value Partners launched, we have 100 constituents within our ETF. So when you buy that single ETF, you actually you get the direct and immediate exposure to these 100 names or 100 securities. So in a way, you actually kind of like settle from the diversification point of view. At the same time, I think like what I already mentioned earlier, you can be a bit creative by trying to create a global ETF portfolio, of which you try to combine the different kind of market exposure. So I think in Bursa, there's a few ETF that has the underlying traded in the US, in China, and even for ASEAN and even Malaysia and other types of asset class such as gold. So you can actually use this different kind of like ETF to actually build your own global ETF. What interesting in doing this is that you can actually try to incorporate your own view by making some technical adjustment on the asset allocation itself. So like I said, if you think that the US is going to perform better this year, then you actually allocate more fund into the US ETF and vice versa. And I think the last one for individual investors is more on the core satellite approach. I do understand. I think most of the investors have are familiar with investing in individual shares. So I assume that you do have like the domestic single stock portfolio. So what you can do is actually, and this single stock portfolio actually make up the core part of your portfolio. So what you can do is actually allocate a small amount, which is what we call the satellite, to invest in this overseas underlying ETF. so that you can actually diversify away from the home country buyers and the home market risk. And I think that's pretty much for the individual investors. So if we move on to the institutional investors, I think things get a little bit more sophisticated here. So I think I'm not going through the details here, but I think for institutional investors, they can actually use ETF for transition. Let's say that they decided to allocate some money for a fund, but then in onboarding the new fund probably takes quite some time. So in between that time, they can actually use that money to invest in the ETF. That way they can actually get the market exposure at least, so that the cash can be utilized lah. At the same time, they can actually use the liquidity sleeve. So this is more applicable to like the pension fund. So you know that every month, institution like EPF get money every month, from our salary. So they actually need to utilize this money to invest. So one of the quickest way to actually do that is via ETF. And I think the rest is more on the portfolio completion. So let's say if you have like a stock portfolio, but you don't really have exposure to China, so you can actually buy the ETF China to actually complete your whole portfolio kind of thing lah. I think that's pretty much on how investors, be it individual or institution, use ETF to invest.
I think that's a very great insight for retail investors like us to learn how we can utilize exchange traded funds as a means to build a more diversified portfolio. Yeah. All right. Yeah. Any other panelists have anything else to share? All right. So I think we have to move on. So I think I just want to remind all of you here to pay attention in this webinar, because there is a quiz at the end of this session, and we are giving away Touch and Go e-wallet reload pin worth 600 ringgit in total to the top 3 winners of this quiz. So pay attention in these webinars. Okay. All right. The next question I have is that financial advisors globally have been turning to ETF to build long-term investment portfolios for their clients. Why are ETF chosen as their preferred products for their clients? Lee Choo, maybe you would like to take this question.
Yeah. This is actually a very interesting question, because a couple of years ago we were looking at, why is it that the ETFs in the developed markets actually has higher adoption as compared to Asia. The actual reason for that is simply because the financial advisors in the developed markets actually make more commission or make more money from ETFs. Why? Because today, if we look at how a unit trust agent is being remunerated, right? They charge investors sales charge and they receive a part of it as their commission. Now, what happens in the developed market is that the financial advisors used to do the same thing as well, where they charge, their clients the sales charge, and then they make their money from there, right? Or their salaries from there. But because of the tight regulations in the developed markets, I think they wanted to stop people from overcharging and also shying away from product pushing. Because if you think about this like as if you're prescribing a medicine, right? Naturally, if I'm paid more by promoting a certain medicine, I don't care whether it's beneficial for the patient, I will just prescribe. Okay, so what happens is that there was this shift in them trying to promote ETFs, because ETFs management fee is a lot lower. But what do? They overlay it with their advisory fees. Say, for example, right, in the past, unit trust funds, maybe in the US, maybe charges 1.5% management fee. So as remuneration, maybe the salesperson pocket 0.5% of this management fee as their incentive, right? Now, what happens with ETF? Because ETFs in the US has also gone to dirt cheap level, right? So the expense ratio could be as low as 0.3% or even sometimes 0.1%. So what did the advisors found out? They realized that, hey, I use ETF as to say that this is a benefit to the investors because I lower down your expense ratio. On top of that, I charge my client a recurring fee of 1% per annum as advisory fee. So what happens is that from the advisor's point of view, I've made more money because I've provided you advice. I made 1%. But if I were to sell a unit trust fund, I only made 0.5%. So there was this shift in the financial advisors' behavior where they move from selling mutual funds to using ETFs because of its low cost reason. And on top of that, a lot of people don't know, they actually made more money out of it, out of, selling ETF or recommending a portfolio consisting of ETF and not mutual fund. Unfortunately, over in Asia, I think the challenge is quite the same across even markets like Singapore, Hong Kong, Taiwan, etc., where it is quite difficult for us to move towards that direction, also because of how the environment is and the culture. So, in the US, people pay for service. Whatever they do, they pay for service, right? But in Malaysia, we tend to be a little bit more petty about paying for service. I mean, I don't know whether is this an Asian mentality, but typically we want to get things for free lah, right? So it is fine, as an investor, if I, maybe don't get sales charge, and I feel happy lah because I cannot really see the fees. It's sort of like, not really known, but we just don't want to pay. If let's say, for example, if I have an advisor sitting in front of you and tell you, hey, I'm going to charge you 0.5% per year as advisory fees, you'll probably be like, why are you charging me? I'm not going to pay. So this is also, I guess, one of the main reason as to why ETFs sort of has this challenge in taking off in the Asia market, because of how the financial advisors are being remunerated lah. So it's not that ETFs in Malaysia doesn't have demand, it is not good, etc., etc. But I think these are some of the potential challenges that we all face generally. So we do hope that the trend eventually would catch on, where financial advisors will subsequently start to use more and more ETFs in their recommendation.
All right. I think that is a very interesting observation that you share. I saw that, Ong and Kamal also smile when you talk about Asian mentality. You have anything to add on? Okay, let's move on to the next question. Now, Bursa currently offers investors a range of ETF strategies to choose from. But how and what should an investor look out for when you want to select an ETF? Lee Choo?
I guess this question really depends on what the investor is looking for, right? I think whenever we construct your own portfolio, you should always start with what is your objective, right? Is it for long term? Is it for short term? Is it for speculation or whatever? So if you think you have a long term in mind, say you're building up, for your retirement savings, I guess the natural thing to do is to first look at asset allocation and geographical allocation. A lot of people like to say that a bulk of your savings are already in EPF, and EPF predominantly invests onshore. So your onshore allocation is sort of like settled, right, through the EPF portfolio. Then what do you do with your cash portfolio or the cash that you have? So instead of adding on to local or domestic exposure, perhaps you could use it to buy into funds or could buy into ETFs that gives you exposure to the offshore market. I think naturally, it really, at the end of the day, depends on what investors want to achieve asset allocation, and then subsequently then decide whether do you need an active strategy to help you in this region, or do you need a passive strategy to help you in the region. Let me give you an example. I think in the US, why the S&P 500 ETF has grown so big is simply because, you know, a very low percentage of the active fund manager can actually outperform the S&P 500. So for markets like that, then you should perhaps consider using a passive strategy to get exposure to that market. So then passive makes sense. But there are markets, for example, maybe in Malaysia, maybe the percentage of the active fund managers being able to outperform the FBM KLCI is actually sort of higher in Malaysia. Then maybe it makes more sense for you to pick an active strategy. But again, you know, it's also debatable, right? It's up to you. Maybe you want to do 50-50. You want to allocate in, say, US, but you also want to take a bet on a certain fund manager who you think is good. Then you can also sort of have this strategy where you say, okay, I want to allocate 10% of my portfolio in the US market. Perhaps I can do 50% in an active fund and 50% in the S&P 500. So this strategy, you know, is actually limitless. There isn't really a one size fit all. Sometimes it also depends on how much AUM or how much assets do you have to invest, right? If you look at unit trust funds, sometimes it goes from as low as 1,000, but you can compare it with ETF where you can buy one lot, which is 100, say maybe about 100 ringgit, if let's say the ETF price is at $1. But you have to also consider the fact that if you purchase just one lot, and perhaps you are investing $100, but what is the brokerage fee that you are paying? You are paying, you know, most of the brokers charges a minimum brokerage fee, right? Let's say $10. $10 of $100 is 10%. If you buy a unit trust fund with $100, even if you pay up to 5.5% sales charge, you are actually still paying lower. So I think there are a lot of all this consideration that you have to, you know, sort of look at before you arrive at the decision as to what strategy or what you know, makes sense lah. So for us, we have products like gold. For example, gold is an asset class that most likely you have to invest in a passive strategy, right? So you can't do active, right? There's no, unless you're looking into gold mining stocks or gold mining fund. Other than that, you know, having an exposure to gold is really a matter of whether you want to increase your exposure or lower down your exposure. So if we go back, you know, I think go back to the how one should actually select an ETF. There is really a lot of things to look at. I think you need to first review the strategy. So for example, if you want exposure to China, Kamal has got a new China A shares ETF that is Islamic. On my side, we have a new China economy ETF that tracks the S&P new China index. So you should then look at the theme, right? Do you want exposure to A shares, or do you want exposure to the non-A shares? So if you want exposures to A shares, then you go to Kamal, right? If you want exposure to non-A shares, then you come to us. But why do you need to choose again? You can have both, right? A shares and non-A shares.
Yes, so, I totally agree.
Yeah, so I think you know, all these factors are important. Of course, there are investors who will also look into, you know, the details. For example, I have done, you know, okay, let's talk about gold. Gold today, a lot of people used to tell me, you know, hey, why should I buy into your gold ETF? I just buy into Spider Gold. Spider Gold, you know, AUM is at 42 trillion. Their total expense ratio is at 0.4%. If I buy into your ETF, the total expense ratio is higher. Your fund size is so much smaller. Does it mean that our fund actually underperform the Spider Gold ETF? I think if you go to any charting tool today, you can sort of track the performance of these two ETFs. Actually, if you ask me, it's actually comparable. So don't, sometimes as an investor, right, I think we tend to think too much, like we want to sort of maximize every single cent so that we don't pay this fund manager this much, you know, and we actually forgot about the big picture. Do you want convenience? Do you want to be able to consolidate all your portfolio within Bursa or within Malaysia? Or do you actually want to open account everywhere and then start, buying things here and then start losing track of where your portfolio is and how to sort of manage it? So I hope that long answer sort of gives you a perspective of what I think.
Yeah, I think that's also a Malaysian's mentality. Okay, that would actually lead me to my next question, which is I think we more or less covered that a little bit already. I think when I talk to some investors, local investors, they were commenting that your limited solutions here in Bursa, lower trading volume. So this has driven many to seek alternative investment in foreign markets. So is investing in foreign markets the best option for investors? Would you want to expand on that, Lee Choo?
I think, like I said, it may or may not be. Again, for me personally, I think it doesn't really matter. But again, it's convenience, right? For me, I'm a big believer of convenience, or maybe I'm just lazy. If I can just lie down at home, sit at home, just order Grab, I don't have to move, don't have to drive my car, I'll probably do that. But there are investors who tend to, I guess, want to try and maximize your returns. So you would want to be choosing the lowest expense ratio product. But I'm not saying that it's not good. I think it's definitely a good practice to have. But a lot of times when we invest into the foreign markets, right, investors tend to forget one thing. Today, when you want to, say, open an account with a broker and then trades a US ETF, what do you have to do with your money in ringgit? You have to convert your ringgit to US dollar. And when you perform a conversion, an FX conversion from ringgit to US dollar, there is that hidden spread that nobody talks about, right? And okay, I like to use Maybank. Maybank always become the victim of comparison. If you actually go to Maybank's website and pull out the rates, the FX rate for their TT charges, right, or rather the FX conversion rate for TT, you will see that the spread, the bid between the buy and sell price, the spread is easily 4%. So have we all forgotten to add on this 4% to your total cost when you invest into, say, S&P 500 using, I don't know, maybe a broker from whoever, right? And every time you buy and sell, perhaps you may have to incur that 4% FX cost, again, that nobody talks about because it's not like it's not a line item in your statement or in your thing, right? So and we also get a lot of times people ask us, then why is your spread so high? Why can't you lower down your spread? So we have to draw that comparison with an investor trying to convert their cash to foreign currency and then subsequently investing into that. Don't forget that there are also FX costs that you perhaps have forgotten to account for in your returns. So I guess there is no right or wrong answers. Definitely investors who doesn't want the exposure or doesn't want to basically get access to foreign markets in the foreign market itself, then you can consider investing into like the China ETFs. I think Kenanga has got the My ETF that gives you exposure to the US market. You might as well use that instead of going directly to the offshore market.
Yeah, I think you really pointed out one more considerations that we should think about, which is the currency exchange rate as well. Do Ong and Kamal have anything to add on?
Yeah. So first of all, I want to thanks Lee Choo for make advertisement for Kamal and myself our product. Okay. Yeah. So my view is actually the same. So in like in Lee Choo's word, we call it why should I need to choose, right? But in my interpretation, this is something very important when it comes to investment, where we call diversification. Diversification is always, good, when you are looking at, a long term, especially when you're looking at a long-term portfolio. So my view on whether, whether investing in a foreign market is the best option, it really depends on how you look at it, and what does the investor want. It is very important that one must know what exactly you want. So of course, the very basic is that, of course, I want to make money, right, or preserve or preserve my capital, or grow in long run. So we know that every country's or every geographical exposure will give you different kind of return, especially on timing. Like for example, when US are up, Malaysia may be more sustainable, because Malaysia tends to famous for low correlation with the global market, meaning which when other markets are dropping a lot, Malaysia may not drop as much. But of course, there are situations whereby most of the countries are all move in the same direction, when it comes to a huge market corrections and all that. But what important is that my view is that it is always good to have diversification. You can allocate a 20-30% of your exposure in US, or if you believe in, say, like ASEAN will be the next growing economy, or China or whatever, then you may allocate some of your portion of your investment into that market. And what good about ETF is that you do not need to think and analyze at company level, what does this company do, whether Facebook do better, or Amazon is better, when I want to invest in US. No, you don't need to have this, you may not have the time to go into each of the company in detail. What you can do is, you just think that, I want to have exposure in, say, a US. Then you can consider i-VCAP's US 50. If you want China, you can consider Trade Plus or Value Partners. They have so these are the in a big picture. You just need to manage your big picture on what are the exposure you want to have. That's it. Yeah.
Thank you so much, Ong, for sharing your perspective.
Yeah, sorry, Shane, if I may add also. Yeah, I think that the key point to add here is what both Ong and Lee Choo has already said, is diversification. Although there's no right or wrong in terms of whether or not investors should go for the foreign markets, but I think that the key idea is you need to diversify your portfolio. And I think when we talk about, domestically as well, I think Malaysia market has its fair of challenges, I think, in the past, quite recent years. So I think it's good for investors to actually diversify the home market risk that they might have. And I think, like what Lee Choo has already mentioned, I think each individuals in Malaysia probably has exposure to the domestic market, either via ETF, via the likes of PNB. So I think it's good if you can diversify this kind of portfolio, so that it doesn't really concentrate into just one single market. And I think when it comes to what to choose when going overseas, I think that this is where you need to have, in a way, some sort of your capital market expectation. If you don't mind, probably a little bit of advertisement for for our part on China, for both Lee Choo and myself. I think if we look at the MSCI ACWI, in terms of the index composition, I think about 60% is already in US. Meanwhile, I think about only 4% is in China. But if you look at the GDP contribution, I think we know that US is basically the largest economy in terms of GDP. But actually, China is the second largest economy in the world based on GDP. And I think looking into the next decade, probably there's a high chance that China may overtake the US. So if, let's say, investors want to take advantage of this structural changes that is coming in for the coming decade, then maybe they can consider buying into China kind of like product. So yeah.
Yeah. Okay. I got your perspective. I think if we just look into the ETF available on Bursa Malaysia, it would have given us, adequate exposure to the US market, the Chinese market, the bond market, and also the commodity market such as gold. Right? Is there anything else I missed out? Also to a neighboring country, the capital market in the neighboring country in ASEAN, right? So these are,
yeah, we do have ASEAN, Malaysia,
for I think Singapore, Thailand, or Indonesia, if I'm not mistaken. So I think for retail investor in Malaysia, we may not need to leave the Malaysian shore to gain exposure to the foreign markets. So these are the convenience that you can get from trading ETF in Bursa Malaysia. All right, so I just want to echo that. Okay, now I think we want to go to the most important segment of this forum, which I want to focus more on inflation. Inflation has hit us right, left, and center in the current moment. So maybe can you share with us now what is the current landscape in the ETF markets, both globally and locally? What are the trends and opportunities we are seeing in this current market right now? Maybe Kamal would like to take this.
All right. So I think I'll start off with the global first. So I think when we talk about the current landscape or the trends, I think in the near term, I think the inflation theme is basically is very dear to each investors lah. Because we are seeing the very stubbornly high inflation globally, and that the fact that the central banks around the world must have to actually increase the interest rate. So when it comes to inflation, the theme on inflation, so I think investors on the ETF is looking on ETF. I mean, there's an interest in the ETF such as TIPS, the Treasury Inflation Protected Securities. At the same time, I think there's also interest in the commodity linked ETF because I think the inflation is actually derived from the higher commodity prices. So basically, some investors want to take advantage of that increasing in the price of commodities. And I think at the same time, they also do invest in equities that link to commodities. So let's say like gold mining companies. So I think that is the kind of equity exposures that investors may want to have at least in the near term in order to actually tackle the problem of inflation. And then I think locally, in terms of the trend or opportunities that we are seeing, I think if you look in the past 1 or 2 years, I think we saw that a lot. Not really a lot, but there's a number of instances where we see some sort of corporate governance issues, be it the forced labor or forced labor issues surrounding some of the Malaysian corporates. So I think there's an increasing trend or demand in the ESG space as well. And I think I do think that this is the long-term trend that will actually have a spillover effect on the local ETF space as well. So I think that's pretty much it.
All right, thank you so much, Kamal. How about Lee Choo? Do you see any trends and opportunities in this market?
I think generally the trend for ETF is rising. I think especially in the developed markets, we really, year in, year out, see that the numbers grow rapidly. The number of products as well also has increased. In the past, I think there were a lot of hype on ARK's ETF. But given that the downtrend in the technology sector, I think those funds have suffered quite a fair bit. But I also think that those could potentially be opportunities because whatever that goes down eventually will come up, right? It's just a matter of timing for it to recover, which I think nobody has that crystal ball to be able to pinpoint and tell you exactly what asset class or which instrument or which fund will eventually rebound. So I think staying diversified is still the most important thing to do lah. And I think the trend, like you know, I echo what Kamal has mentioned, that the trends that we are seeing currently is really more towards that. But we also do think that there are a lot of investors who take opportunity to sort of, you know, average in on some of the tech sectors, and also the S&P 500 to basically beef up their core portfolios. So China, I think China, US is definitely the markets that people are interested to get into.
All right, thank you, Lee Choo, for sharing your perspective. How about Ong? Do you have anything to add to this question?
Yeah, sure. So looking at the current market condition, you know, it looks like it is more on the bearish kind of market condition currently. You know, globally, we see year to date, US has down 20% on the S&P 500. You know, Dow Jones has down 15%. You know, Malaysia year to date has down about 8.8%. And we are, you know, we are hit by, you know, high inflation and also the impact from the rising interest rate and market uncertainties and so on. And at this is the time that, you know, a lot of investors, you know, feel the fear and, you know, and don't know, you know, what to do. But actually, if you look at the long history of the capital market, we all know one thing is for sure, you know, markets are always volatile and they are always ups and downs. And, you know, this is not something new. You know, in fact, if we can refresh our memory, just like 2 years ago, you know, when COVID started to hit, you know, a lot of people think, you know, this is like, you know, end of the world, you know, the market has down so much and all that, but we can see that market quickly has rebounded. So what I'm saying that today now here is not that I'm trying to say that market will rebound very fast. No, but what I'm trying to say is that in every situation, you know, there are ways for you to position yourself, how you want to manage your investment portfolio. So generally there are a few types of investor. You know, first one will be, you know, more low risk tolerance, you know, looking for capital preservation. So for this type of investors, you know, if they want to preserve capital, you know, for long-term portfolio, you know, they may consider things like, you know, in terms of how you want to use ETF, you know, to position your investment, you know, you may consider things like, you know, more say quote unquote, you know, safer bets, you know, on the dividend ETF, you know, advertisement time again. For i-VCAP, we do have 2 dividend ETF. One is the Malaysia one, another one is the ASEAN one. So and also during bad times, you know, you may want to look at things like gold and so on. So okay, so this is for, you know, capital preservation type of investors. So the second type may be, you know, maybe investors that trying to look at diversification, trying to look at, you know, now I know the market is down, you know, I want to position for a rebound. So for this type of investors, you know, one thing about what Lee Choo and also Kamal has mentioned, you know, nobody has the crystal ball. You know, we won't know, you know, it's always difficult to time the market. So what you can do best is to diversify, but, you know, position well for the next rebound. Like, you know, for example, in the US, we know that S&P 500 has already dropped 20%. Look at the history, you know, the long history of US, you know, S&P 500. You know, every few years, you know, if you were down 20-30%, and the rebound will be very, very, very great, you know. So, you know, investors, you can go and look at the chart. The trend is always repeat itself. So if this type of, you know, investors, you know, you may look at, you know, US based ETF, you know, you can have your exposure there. You know, don't go all in one shot. You know, maybe you can time it. You know, maybe you can diversify. You know, have some in the US. You know, some in China, some in especially ASEAN, because ASEAN, you know, is very badly hit by the economic the COVID, and the opening theme will be actually good for them. So, you know, you may consider that as well. So these are the second type. And also we always have a third type of investors whereby higher, what do you call, a higher risk tolerance, try to more trading in nature. For this type of investor, actually, I try to share with you one thing that how to make money when market are down. In our current ETF product, there's one product called inverse ETF. Many investors do not know or aware that actually in Malaysia we have inverse ETF. What does inverse ETF do is, when market are down, when you buy this ETF, when market are down 1%, you actually gain 1%. So this is, you are buying the down market. For investors that think that in short term market will still go down, then you can have, you can invest in that. Or for any investors that already have exposure, like say, for example, now I already have, Malaysian stocks. I want to sell, because it's below my cost now, but market keep going down. What do I do, right? So you hedge yourself by buying the inverse ETF. So to hedge your position, that when market continue to go down, you will not suffer that much of losses. So when the time that you know that is bottom and the market has started the uptrend, what do? There is another type of ETF available in the market called leverage ETF. So leverage ETF, like for example, the 2X KLCI leverage ETF, they give you exposure of double of the market when it's up, meaning which if market up by 1%, if you buy the ETF, you will be up by 2%. So, we have various type of product, ETF product actually available in Malaysia. It's just that a lot of investors actually do not know how to use it. So make good use of it, know this and make good use of it, of this, and you will be able to position yourself, in different type of market condition.
All right, thank you so much, Ong, for sharing your perspective on this issue. So we definitely have a whole suite of ETF tools available in Bursa Malaysia to meet the different investor need. So to put your portfolio, be it in investing or be for short-term trading. All right. So let me go to my next question, which is focused on inflation, rising interest rate, and so market uncertainty. So for in this market, right, we have high inflation, rising interest rate. Central banks are very hawkish, around the world, okay, including Malaysia, and with a lot of market uncertainty and market volatility as well. So that's the global theme that we are faced with today. So how should an investor position our portfolio in today's financial landscape? Lee Choo, you have any idea?
I think definitely should stay diversified. As much as all of us are impacted, I'm sure your portfolios and my portfolio is impacted as well. I think it's a matter. Shane is crying already. Cry also, no tears, I no need to cry. I think it's a matter of staying patient, being patient, because all of us sort of been through, the ups and downs in the market. We know that, we just need time for to give the market to sort of come into place and then rebound and move on from there. So of course, if I have the bullet now, I will try and average down as much as I can. But I guess not all of us may have that luxury of having the cash, because your funds are already tight in the market, unfortunately. So I guess in this case, just try not to think too much about it, go and enjoy yourself, have fun, and I believe the market will come back soon. Of course, we don't know when the timing would be, because if we all had the crystal ball, then I don't think we'll be working anymore. I might as well just open, just borrow as much money as I can from the bank and just sort of go all in any of the asset class if I have the crystal ball, right? So I believe that staying highly diversified is important, and then focus on the long-term goal. If you are not looking at it from a short-term perspective, just continue to average down, just continue to average in, because I believe that dollar cost averaging would help for sure over the long term. Because really, seriously, I don't think anybody here could confidently say that they could time the market and they know when the bottom of the market is.
All right, thank you so much, Lee Choo. How about Ong?
Yeah, like what I have mentioned just now, I have shared, on different condition, a different type of investors, when you are, how you should position yourself. If you are conservative, now you just, go back to a safer haven, in the sense that, dividend yielding kind of ETF, if you want to play the market, currently based on the current situation, you can try to use inverse and, leverage kind of things. But for generally for a broader, market of investors, I believe what you can do or you can consider doing is, how to position for the rebound since market is down, right? So you try to position yourself, pace your investments, you don't go all in one time now, maybe you invest in batches, and diversify in different market, then hack the index, by investing in ETF, US, China, ASEAN, Malaysia, when market rebound, when very often that we know that when market are down, everybody, scared, feel fear to invest, while the market start to go up, they are, how do I say this, they are unable to chase the market, right? And especially when you come to individual retail investor who invest in the individual or shares, you wouldn't know which stocks will move first, so you may lose the kind of opportunity when the market are rebound. So best to do is actually to hack the index, to believe, if you believe that, US, still have rooms to recover, Malaysia will come back, or ASEAN will come back, or China, or whatever regional, market, invest in the ETF, the broad market, and you won't miss the opportunity, that is for sure.
Right, thank you so much, Ong. Kamal, do you have anything to add to this question?
Yeah, probably just a bit more. Yeah, I think if again it depends on individual investors' preference and their situation. So if you don't really have any kind of like an urgent liquidity requirement, I think it's best if you just try to ride out the market downturn. And I think like what Lee Choo and Ong already said, I think dollar cost averaging is always one of the best way to actually trying to actually lower down your cost of investment, because again, you don't really know when exactly the market is going to bottom out, right? And then at the same time, I think some investors may be tempted to actually like sell down their beaten down portfolio and try to raise cash, but you have to bear in mind we are living in a high inflation environment, so that might not bode so well for your cash position as well. So again, if you don't really have any urgent liquidity requirement or some constraint, stay invested in the market and try to do some dollar cost averaging to probably catch on the rebound hopefully soon. Yeah.
All right. I think what I learned from panelists for this question is that dollar cost average strategy will work. And if you have a hedging perspective, you can go for inverse ETF, or if you are very tactical in terms of the short-term bullishness, then of course you can go for leverage ETF lah. So stay diversified, okay, and also stay diversified. All right. So let me go to the next question. Now we know that the ringgit has weakened against the US dollar for quite a fair bit. So given the recent weakening in Malaysian ringgit, can we use ETF to hedge against the forex fluctuation, especially for a long-term portfolio? Maybe Ong, would you like to take this question?
Well, okay, yeah. So as we all know that ringgit has been weakening recently, 4.44 against dollar, and there are a lot of people who actually start to worry, especially who has requirement, or the needs, that they want, they may want to send their children to overseas to study and so on, So this is actually a real problem. So currently in the market, how do we is there any way that we can use ETF to hedge ringgit? There is, not really advertisement time, but I have to do this advertisement because there are not many actually USD denominated ETF in the market. But i-VCAP actually do have one, the US 50 ones that is denominated in USD. So when an investor buy into this ETF, you just do the same buying as though like you buy any other shares in this listed in Bursa, but your broker will actually help you to convert your amount into the USD and buy into the ETF. So what does the ETF do is the ETF invests in the top 50 US company. So in other words, you actually hedge your position by owning a USD asset, asset in USD. So like, for example, say I have a requirement that I want to send my children to US to study in 5 years' time. So what do I do, right? I may work very hard today, keep my money, in FD 5 years down the road, I see, hey, oops, USD has strengthened so much that I still don't have enough money. So what you can do is, pace your, do like a regular saving plan kind of situation, you buy into a US ETF, every 3 months, every 6 months, you buy one batches. So over the years, what happened that what is the beauty of you buying in long term is that you do away the timing problem. Okay, because we are not able to time the market. We don't know when is the up, when is the down. So if you consistently buy over the long term, you will get the so-called long-term market return. We all know that in US long-term market return since 1950s is, until now is like 10%. So you let your money slowly grow, while you keep contributing into it. In 5 years down the road, you will have the USD investment, that you can fund your children's education, in this manner. So just give an example, if 3 years ago, if I consistently, buy the US 50 ETF, until now, my plus the what do you call the FX gain and the capital gain, I will be easily up by like 70%, So these are one of the ways that you can use it, especially for the retail investors long term, to hedge against it. It's not really a short-term hedging, but in long run, this is what you can do by investing, into ETF to hedge your FX exposure.
All right, thank you so much, Ong, for addressing my question. Do Lee Choo and Kamal have anything to add to this question? Okay, looks like no, right? Okay, cool. So I think that shall conclude the questions by me. So we would now like to open the floor for questions, okay, for our attendees today. So if you have any questions to ask our esteemed panelists today, you may write them in the Q&A box, not the chat box, okay, Q&A box, so we can address them accordingly, all right? Write them in Q&A box. Okay, the first question by Stephen Fu. Most ETFs are passively managed. However, ETF managed by Cathy Wood, like ARK, is not really passively managed. Kindly share why Cathy's ETF are actively managed. Anybody like to take this?
I think there is no reason as to why it's active or passive, because I think nobody says that ETF must be passive. right? Just like a fund, unit trust fund. Nobody says unit trust fund must be active, right? There are passive unit trust funds as well. So it's actually a matter of structure, because ultimately, whether you're an ETF or a unit trust fund, you are still a fund. The structure is the same. It's just the manner of how the fund is being traded or being transacted is different. So it depends on what the manager wants to achieve. Perhaps they think that by listing it on the exchange, it could get a higher subscription or investment rate. So I think it's really a decision that is being made by the fund manager.
All right, thank you, Lee Choo. The next question is, how do we classify a good ETF? Do we follow the index? Is that considered a good ETF? That is by Si Jia.
Yeah, I probably can take this one. I think if we talk about passively managed ETF, I think one of the key criteria to see if it is a good ETF is that the tracking error. Because as we know, passive ETF track the benchmark. So the tracking error is basically trying to show that the deviation between the ETF against the benchmark. So the higher tracking error, it shows that there's a bit of deviation from what the ETF manager is supposed to do. So the lower tracking error usually means that the ETF in a way is a good ETF, I would say.
Yeah, if I may add on also, another thing to consider the ETF is also you may want to look at the what do you call the fee as well. Yeah. But the very key thing for a good ETF is that if it matches what the needs or the objective of the investor, then the ETF can deliver whatever the investors wants, then that is a good ETF.
All right, thank you so much, Ong and also Kamal for sharing on this. The next question by Chi Kyung is, will ETF pay dividends?
Yeah, let me answer. Maybe I answer this.
Sure.
Yes, ETF do pay dividend. Yeah, like what I have shared, that in fact we do have a dividend ETF that invests into a dividend stocks, and there are the ETF generally they pay dividend also for those equity ETFs, of course. And the ETF, how the ETF pay dividend is actually almost the same as how when you buy into the shares, the dividend will come in, or automatically bank into the bank account that you register with Musa, same as any other shares that you buy. Unlike unit trust generally, when they pay dividend or distribution per se, they will give you extra unit. But for in ETF, they will pay you in cash.
All right. Do you accumulate 1 year payout annually? Because you have so many constituent stock, right? How do you manage the ETF, the dividend payout?
Oh, it doesn't matter, because for the constituents, say for example, I have I have 30 stocks in my ETF constituents, so I will receive dividend from time to time from all these investment. But for us, as an issuer or to pay out dividend, it will generally once a year, declare dividend.
All right.
I think as a guide, you can read through the prospectus of each ETF that you're interested in. There is a section that talks about income distribution policy. So in that section, it will specify whether the fund would potentially pay dividends or not. So not all funds are structured the same way. For example, like gold ETF, we don't pay dividend because gold is not an interest paying asset. So all this will be clearly stipulated in the prospectus of the fund.
All right, thank you so much, Lee Choo and Ong. The next question is by Weng On. Why does ETF index fund on Bursa Malaysia not perform well compared to S&P index fund in the US?
So maybe let me take this question. So if I may do, if I may have a clarification on this one, or on the question, regarding not performing as well as S&P 500. So what I want to say is that, like what Lee Choo has shared just now, that if we compare, if we compare the ETF in terms of return, on the same, like to like kind of comparison, the same underlying, you will notice that actually the return, of Malaysia ETF are actually the same. So Lee Choo just now has already shared, on the gold basis, it is actually same, Malaysia's gold ETF and, and the one that listed overseas are the same. So come back to the question for S&P 500. S&P 500 ETF in terms of performance, the return itself. Okay, if we compare against, say, US 50 that, invest in the top 50 US stocks in US stock ETF, if you compare the two return for the past 3 years, you will notice that actually we have outperformed even the S&P 500. We underperformed the Nasdaq, but we outperformed the S&P 500. If you look at the performance, actually it doesn't matter, whether the ETF is listed in US or the ETF is listed in Malaysia. The very key thing is to look at the underlying of the ETF. What does it track? Okay, so if, say for example, I have a ETF that tracks S&P 500 in you and another ETF that tracks S&P 500 as well, listed in US. Theoretically, if the tracking error is minimal for both of these ETF, the return should still be the same.
Okay, thank you so much, Ong. So what happens if an ETF is liquidated? This question is by Si Jiang.
Yeah, if I may answer also this, because we do have basically when an ETF liquidate, or close down, it will be the same as any unit trust fund or whatever that closed down. What they will do is that they will sell off all the underlying and give back the give back the proceeds to the investors. It will be the same as shares. In shares, sometimes your shares get privatized, and it will be the same situation. So the investors will basically the fund will sell off all the underlying and distribute back the proceeds to the respective unit holder. And we are, because ETF is a registered and well regulated investment instrument, so investors is protected in this manner.
All right, thank you so much, Ong. The next question: typically, who are the market makers in ETF? Are they neutral in their decision making? This is by Wing Ong.
I think, probably I can take this one. I think usually the market makers are basically the participating organization as approved by Bursa, and it can be either be a licensed bank or licensed merchant bank, or even a related corporation. Between the licensed bank or licensed merchant bank lah. In terms of whether they are neutral or not, they usually take both sides of the spectrum. They do have the bid and they do have the ask. So I don't think they some of them may, when it comes to market making, some of them may hold inventory, and if not, they probably do the market making via SBL. So definitely there's a cost associated with those two. So I think when we talk about ETF market, it's not really a money making machine unless the size is very big. So I think it, in this kind of ecosystem, everyone needs to survive, right? So I think probably that's the reason why I think some in terms of spread may be a bit higher, because they do need to cover some of the costs when it comes to doing the market making. Yeah.
Yeah, that will lead to the next question by Johnson Ong, who asked that why the spread for some listed ETF is very huge if the management fee is lower than the unit trust. For example, the China ETF spread is always 7 cents, which is more than 1% of the price.
Let me take this question. The China ETF is one of Affin Hwang's ETF. So it essentially, like I said earlier on, right, it depends on, Kamal has pointed out a point where market makers are appointed to make market and to provide liquidity. But is it fair? I mean, if you think about it, how do market makers make money? They rely on volume. If there is a lot of activity in the ETF, there's a lot of people buying and selling, then the market makers will make the spread. But in an environment, in this current environment in Malaysia, especially when the ETF market is not that active, then the market makers have to survive. They can't just sit on the inventory of these ETF units and not make money out of it, because if they don't make any money out of it, then I guess it's a matter of time that the management of those of the market maker company will which is the investment bank or the PO, will essentially come down and say that, hey, this is not a profit generating business, should we close it down? So I think this, I believe, would improve over time as more and more investors are aware of the product or of ETFs, and that's when the market makers could sort of narrow the gap of the spreads that they quote. Secondly, that if there are more participants, especially when there are more retail investors or even institutional investors coming into the ecosystem to participate in the ETF market, then naturally it will also tighten the spread. I think other than that, we also have to look into what are the costs that the ETF market makers have to incur, right, as a result of market making. So for the China ETF, the spread is a bit wider, but if you compare it from the perspective of if you have US dollar or even Hong Kong dollar, Malaysian ringgit, and you want to invest directly into Hong Kong listed shares, you have to do your FX conversion. Again, like I said, the example that I give you, if you convert your currencies, especially if you are only converting a small amount, you're not going to get favorable conversion rate from your banks, right? And there would be definitely maybe a 3-4% FX conversion spread that you can't see as a hidden cost. So I think if you look at it that way, then the spreads are not exactly that bad lah. Of course, when we talk about ETFs being low cost, we generally are referring to the management fee that we charge, which is typically lower than an active unit trust funds. Yeah, so I hope that addresses your question.
All right, thank you so much, Lee Choo. The next question is rather interesting and intriguing. Not sure who would like to take this. So let me read out the question. The remuneration of a fund manager should be based on their performance and not currently based on a fixed fee on the annual management fee. Currently, we have to pay the annual management fee even though the fund is not performing or give negative returns. So what is your view on this?
Can I take it first? Probably Lee Choo and Ong can add a bit later. Yeah, again, like I said, when we talk about ETF in Malaysia, it's generally passive. So we tend to try to mimic the benchmark. So if the benchmark fell by 10%, is it our fault that the ETF also fall by 10%? Because what we do is replicate the benchmark. Otherwise, if we deviate from the benchmark, then definitely the tracking error will be high, and then this no longer, I mean, it already defeat the purpose or the objective of the ETF itself, which is to passively mimic the benchmark. And at the same time, I think you have to remember, like what I mentioned earlier, ETF, it's not really a profit generating or money making machine. So of course, we will try to minimize the cost as much as we can, but we also, as an ETF issuer, incurred a lot of the costs associated with the ETF itself. I think one of the biggest cost is probably the index providers. So we have to pay the index providers to get on the information on the constituent itself. And then at the same time, there are other stakeholders such as the data service providers, the trustee, the custodian that we also need to pay. So I think it's a bit unfair if you say that the fee should be based on performance when what we do is basically try to mimic the benchmark, and this is actually reflected in the tracking error. The tracking error should be the criteria for the passively managed ETF.
So if I may add on to come out on this. So of course in the investment world we do have remuneration that ties to or track to the performance, which normally we call performance fee, but that generally applicable on those actively managed funds, whereby the skill set of the fund manager is important, is the determining factor of whether the fund is making what type of return. So come back to just to add on a little bit on what Kamal has mentioned, for the passively managed ETF, the management fee is actually paid for all those index provider, for the management, for the fund manager, that needs to do rebalancing, otherwise, the ETF won't work and will not be able to track, like for example, if you buy into an ETF that has a 100 constituents in China. Imagine what the fund manager needs to do in the backdrop. He needs to go to China market and buy according to the weightage of the index, 100 stocks. Then need to rebalance every quarter and so on. So these are the fee that the investors pay in order to get the to get the product works.
All right, thank you so much, Ong. Let's go to the next question.
Sorry, I think if I can sort of give you an analogy, right? Think about appointing or investing into fund as outsourcing your investment mandate, right? I.e., think of yourself as if you are running a business, right? You employ employees. Let's say you open a restaurant and you need to employ chef, but do you pay your chef a salary only when they cook delicious food? Or do you make your customer pay only when the food is delicious? I think at the end of the day, this is a matter of the service that we provide to you. Yes, I agree that sometimes the fund manager may not perform up to the standards, but there are also a lot of other factors that we have to take into account when we charge this sort of fees. Of course, if I can, if I'm very, very confident that I will make 100% make money for you, then of course, then it's fair that we share the performance fee. But I can assure you that even if we work on that performance fee model, let's say we don't charge management fee and we say let's charge a 20% performance fee, meaning if we make money, we keep 20%. And if assuming we make 100% return, and then you come back and say, hey, you're keeping 20%, I think that's too much. So I feel that this is a constant debate as to whether should we pay for service or should we not pay for service. I'm not saying or trying to defend that the asset management company has all the right to charge, and even though we don't make money for the client. But sometimes I think let's not dwell into the short term, because give the fund manager some time to prove that they can deliver the returns to you. If let's say because you're outsourcing your investment capabilities to somebody else, i.e. the fund manager, and after giving them a 3-year period and they still suck and they cannot deliver you the return, then by all means withdraw your funds, move on to another fund manager, or perhaps you could do it yourself as well.
All right, I like what you say. Okay, yeah, do yourself. Okay. The next question is asking, is there any incentive given to retail investor to buy ETF fund in Bursa Malaysia? I think I can take that question. Yes, Bursa will announce it shortly. Okay, there will be incentive for retail investors to buy ETF fund in Bursa Malaysia. So I have just answered that question. Is there any ETF tracking the Vietnam stock index? This question is by Chikyong.
No, unfortunately, not in Malaysia.
All right. So Stephen Lai would like to ask the next question. Does ETF have an expiry date?
Maybe let me take this. No, ETF has no expiry date. You know, it is an open-ended fund that has no expiry. It will go on, you know, as long as, you know, as long as it can be. Yeah.
Okay. All right. So is that okay? I wouldn't say is there. Will there be any ETF fund that invests in cryptocurrency on Bursa Malaysia in the future?
Are we still confident with cryptos?
I have no idea. Okay, I think that the market crashed so hard, right? You see.
Yeah, I think with the current trend of, you know, so many people filing for bankruptcy, especially those crypto companies that actually does provide financing, I'm not too sure whether as an asset class, I believe there is definitely a space for it. However, I am not exactly sure if SE would eventually allow for this, but generally at this juncture, the regulation does not permit issuing of a Bitcoin or rather a crypto ETF.
All right. Thanks for clarifying.
Yeah. If I may add on, you know, but never know, you know, market, you know, is always volatile, and you know, especially when it comes to crypto, you never know 3 months, 6 months down the road, you know, Bitcoin will again, you know, will go up, you know, will rebound above 60,000, you know, attract the attention, and you know, the market will like it, and you know, there are issuers that, you know, might be, you know, interested in looking into that again.
All right, thank you so much. The next question is by Sijia. Like, are you able to explain about my ETF Dow Jones US Titan 50?
Oh, sorry. Can you repeat the question?
Can you explain my ETF Dow Jones US Titan 50?
Explain.
Yeah,
explain
maybe
okay.
yeah.
So just a brief introduction on for this ETF. Basically, this ETF invests in the top 50 Sharia compliant stocks listed in US. So it tracks the top 50. Namely, you know, you have Amazon, you have Facebook, you have Alphabet, you have Tesla, you know, and so on. So this ETF is listed in Bursa Malaysia, but it is denominated in USD. Although it is denominated in USD, you can buy and sell through most of the brokers, you know, just like any other listed stocks in Bursa Malaysia.
All right, thank you so much, Ong. Brandon has a follow-up question to that. Why is there no IOPV for this ETF on Bursa Marketplace?
Okay, IOPV meaning which, you know, the real time, the real time value of the or real time NAV of ETF, you know, during the market. Say for example, I give you an example for FPM. Say for FPM 30 ETF. You know, during the trading hour, you know, the underlying is the 30 stocks, and of the 30 stocks, some go up, some go down, some not moving, you know. So what are the real time NAV of the ETF? You know, IOPV is the answer. So why there is no IOPV for US 50? Simply because of during Bursa trading hour, US is not moving. So the underlying shares, which is the top 50 stocks listed in US, there is no trading because it's US market is closed. Therefore, there is no IOPV.
That explains well. Okay. Ben would like to ask the next question. How would you describe the retail investors' response to the locally offered ETF currently? Is it growing steadily in participation?
I think this one, I believe Bursa has got some statistics. Perhaps they don't share it out, but the participation has been growing in the past 2-3 years. It's not huge numbers, to be very honest, which is why we need to have education awareness such as this. But I think it is steadily improving. But I think on our side, I think it's about the entire ecosystem, right? We need more issuers to issue more ETFs, and at the same time, we also need more participation from the retail investors as well as the institutional investors. So I think once we have all these components working together, then we hopefully could see more active market for the ETF.
All right. Now, Edmund would like to ask next question. Now, China is facing a mortgage crisis as several thousands of unhappy home buyers are refusing to pay their mortgage for unfinished or stall housing projects. So how this situation may impact the China stock market and the China-related ETFs?
All right.
Maybe
So
Lee Choo
yeah,
or
probably
Kamal?
I'll start off, and Lee Choo can add if anything else. So yeah, I think right now, yes, there's a concern on that, but I think probably the concern is kind of like blown out of the proportion, because I think the home buyers basically don't pay because the projects are basically unfinished. So I think probably the possible scenario that we are looking at is that probably the local government will have to step in to ensure that these projects can be completed. And I think once you did that, I think the overhang on the share price will go away lah. But I think at the same time, I'd like to remind. Again, it's kind of like an advertisement for Value Partners ETF, because it is a Sharia kind of ETF. Our ETF don't really have any exposures to the leverage, high leverage companies, which includes the property developer. So I think in a way, our ETF is kind of like shielded a bit from this issue. But of course, when we talk about this kind of issue or concern, it will have some impact on the sentiment for the broad market as well. But I think for us Value Partners, we do think it is quite limited, and I think it should be able to be resolved in the coming quarters. Yeah.
All right. I think let's do one last question. Yeah, I think today we have a very engaging Q&A session. So we'll just pick one last question. So will you consider dividend distribution or reinvestment scheme for? We have 3 issuers here. Will you consider dividend reinvestment scheme?
I think yes, we are actually looking at it, but I believe the issue is also with if we do that kind of scheme, right? Like investors will likely end up in odd lot, and some of the ETFs are priced at say $1, right? If I only pay, if the investor end up holding just like getting one lot and gets a 10-cent income distribution, that we wouldn't be able to issue any units for that. That is actually the challenge. So we are still sort of trying to iron out the operational, parts of this. But we hear you. Definitely is something that we are sort of looking at. It's just how do we operationalize this?
All right. So I think thank you all our panelists for staying up with us until this hour to address all the questions that I have and also the attendees have for you. All right. But I think for those unanswered questions, right, if our panelists have the time, maybe you can type the response to some of the questions that they have here. But I think it's time for us to proceed to our quiz. I think that everyone has been waiting for. So, all right. So if I may just share my screen. Okay. We are going to do this quiz, okay, to reward people who pay attention in this webinar and can answer our quiz on ETF correctly. But this quiz is only open for webinar registrants. So if you are streaming in from YouTube, so you may need to click this link, www.tinyurl.com/ETF Bursa webinar. I put this link in the YouTube chat, so you may click this YouTube chat link to register for this ongoing webinar, so you can participate in this quiz. So this quiz is only open to participants who are tuning in from Zoom, okay, not from YouTube. So if you're currently watching it from YouTube, you just register at this link, www.tinyurl.com/ETF Bursa webinar, so you can join this quiz. All right, so the top 3 winners in this ETF quiz will walk away with e-wallet reload pin by Touch and Go worth 600 ringgit in total, whereby the first place will walk away with 300 ringgit, second place will walk away with 200 ringgit, and the third place will walk away with 100 ringgit Touch and Go e-wallet reload pin. All right, so let me briefly share with you, how do you play this quiz. Okay, the quiz will be conducted on Kahoot. So what you need to do now is to visit www.kahoot.it, or you may download Kahoot app from Google Play or App Store. Okay, you just use one of these 2 methods. Either you open your browser and type kahoot.it, or if you don't want to use a browser, you want to use an app, you may go to Google Play or you go to App Store to download Kahoot app, okay, which is in red color. All right, so either one of these 2 ways. After that, you key in the game pin shown on the screen. I will review to you the game pin in a short while. And then after that, you need to enter your full name as per webinar registration. So if you register in this webinar using the name, like me using Shane Choo, then your name should be Shane Choo in Kahoot. Okay. If you use other name than your registered name in this webinar, we will not be able to track you in the event that you are a winner. All right. So you must use your full name as per what you registered in this webinar. So there will be a total of 11 quiz questions that will be shown on the screen. What you need to do is to select the correct answer on your browser or on your Kahoot app, okay, on your mobile device or your tablet. All right. So when you see the questions, read it carefully and answer it correctly on your application, whether it's browser or it's a mobile app. So the top 3 person with the most number of correct answer within the time limit and the fastest response will win. All right. So the faster you respond and you get it correctly, then you have more points. All right. So each question is allocated 20 seconds. Okay. Each question is allocated 20 seconds. So you have 20 seconds to answer this question. All right. So this is how it will look like on your app, right? So the first step is you enter the pin. Second, the first step is to click this button. Second step is enter the game pin, which I will show you in a while. All right. So what are the rules and regulations? Rule and regulation number 1 is, like what I've said, you must enter your full name as per the webinar registration name. All right. Question number 2 is, rules number 2 is each participant is only allowed to submit 1 entry for the quiz only. Okay, each participant is only 1 entry. The first question is a dummy question and contribute no mark. All right. So in short, there are only the next 10 questions will contribute marks. The first question is to give you a test. Okay, the first question is a dummy question for you to familiarize yourself with the game application. So the organizer reserves the absolute right in determining the winners or disqualifying any winners for any unfair practices if we spot that. All right. So these are the rules and regulations. Are you guys ready? If you are ready, you type ready in the chat box and let me know. Okay. If you're ready, you type ready. Then we shall proceed to give you the game pin. Okay. All of you got the browser ready and the Kahoot app ready? Okay. Fantastic. Okay. Let me share my games pin. Yeah. Okay, so here is the game pin. All right. Can you see my screen? The game pin in Kahoot is 9896341. Okay, 9896341. Okay. See, I have people joining in the quiz now. So go to kahoot.it or with the Kahoot app and enter the game pin 9896341. Okay. I may scroll down for you to check your name. Yeah. Okay. Let's just give you another 2 minutes for you to enter this quiz. If full name too long, how? Then you just do your best lah. Okay. You just key in the name so that we can identify you. Or in the event that you're a winner, then you let us know your full name as per your webinar registration. Okay. That is to address Ong Soon Chong question. All right. Are you seeing your name on the screen? Okay, we have 80 people inside the game right now. Let's just wait for 1 or 2 more minutes. If you need any help during the registration, let me know if you're facing any challenges. Okay, we have 86%. Okay, in the meantime, while we are waiting for our participants to log in, do we have any panelists here who would like to address some pertinent questions that you have found on the Q&A?
I think there was one question that asked about the REITs ETF. I think there were two similar questions. There is actually a REITs ETF listed on Bursa Malaysia, which is issued by Affin Hwang. You can actually check out the Trade Plus MSCI Asia X Japan REITs tracker ETF. So this particular ETF actually tracks an MSCI Asia X Japan REITs index, which we customized with MSCI. So it's also a product which you sort of can't find it in another region or another country. So you can actually check out the prospectus and also look through the index.
All right, thank you, Lee Choo. Okay, looks like the registrations number, kind of plateau at about 90 packs. So I guess most of you here have already signed up. Is there anybody still in the middle of signing up to this Kahoot? If yes, please type me here, ME, so that I know that you are still in the middle of signing up. Okay, Lily, still not yet able, is it? Okay, let me just give you another 1 minute. Okay, only one person. You just go to the www.kahoot.it, www.kahoot.it, and key in the game pin, which is 9896341. All right. I think Johnson asked, what are the incentive for the investment in the ETF listed in Bursa, and where can we check such incentive? All right. You may check out Bursa Malaysia official social media communication channels, okay, such as the Facebook, and there are other channels in like Instagram. So when they announce it, they will announce it on the social media handler and accounts. All right. So please follow them on the social media, so that when this incentive is ready, they will let you know. Okay. All right. So I think I've given enough time for all of you to register for this session. Hope that nobody else has missed out. So I don't want to, I just want to quickly go to this contest. All right. So we shall begin this in 5 seconds. All right. 5, 4, 3, 2, 1. All right. So this question is a dummy question for you all to test. All right, so this is how it is like. All right, so this question has no mark. All right, so this is a leadership board. All right. So the next 10 questions will contribute marks. The faster you respond, the higher points that you receive. All right, let's go. Which of the following features are not one carried by ETFs? Please pick the correct answer. All right, so we have 58% who get it right. All right, let's go. One of the responsibilities of a market maker is. This sounds easy, I think, because we have addressed this question many times. All right, so majority of you get it right, which is providing liquidity by offering bid and ask pricing. All right. So let's go to the next question. How do investors pay for management fees for an ETF? All right, also majority of you get it right, which is already calculated in the net asset value. Congratulations. Okay, looks like Lim Xueqing is leading now in the leaderboard. From the following, which is not true about Sharia ETF? Wow, majority of you also get it right. Okay, whole securities and listed stock is not true about Sharia ETF. Okay, so let me go to the next question. From the following, which is true about trading in ETF? Wow, majority of you also get it right. Okay, can trade via Bursa exchange like any other listed stocks. Okay, let's go to the next question. Which ETF is not currently available in Malaysia market? All right, 48 of you get it right, which is actively managed ETF. The next question is, what are exchange traded funds? This sounds easy. Yes, exchange traded fund is a basket of securities that are traded on the exchange. All right, so 79 of you get it right. Let's go to the next question. This is the ninth question. What are the key advantages of ETF? All right, majority of you get it right, which is all of the above. Okay, this is the second last question. ETF liquidity purely depends on its trading volume on the exchange. True or false? Okay, 59 of you get it right. So the answer is false. Okay, it's not only on trading volume, it's also on market makers, okay, who provide the liquidity in the market. All right, so let's do the one last question. This is the last question already, so you've got to give it your best. Okay, on the secondary market, ETF is always traded at its net asset value. True or false? The answer is false. Okay, because sometimes it trade at a discount or premium to its net asset value. All right. So, ladies and gentlemen, we have concluded our Kahoot quiz. So let's look at our winners. The third place, Tun Atlan. Okay. The second place is Ong Kian Boon. And the first place is Chan Sui Yong. All right. And we have two runner-ups, which is Elaine and also, yeah, I missed the names just now. All right, so thank you everybody for participating in this Kahoot quiz. Of course, we'll reach out to the winners, shortly. All right, so do watch out from the email from Bursa Malaysia, where we'll tell you how to redeem the Touch and Go e-wallet reload pin. Yeah, so for the winners, do look out for the emails from Bursa Malaysia. All right, so hope all of you here have learned enormously in this webinar brought to you by Bursa Malaysia, and also some of you here would have engaged in this game very much. So for those questions that you get it wrong, just remember why you get it wrong. All right, so yeah, so I want to thank all of you here for tuning into this webinar brought to you by Bursa Malaysia. I want to thank all the panelists for coming to this session to share about ETF and the emerging opportunities in this ETF market, and also share with us what exactly are ETF and how do we use ETF to complement our portfolio and reach our investment objectives. So thank you so much to our panelists today, who is Mr. Kamal, Ms. Chong Lee Choo, and also Mr. Ong. All right, thank you to all of you.
Okay, thank you everyone.
Thank you. Bye.
All right, so for our next webinar, we'll be doing uncover money management and position sizing strategies to maximize stock returns. So that's happening on tomorrow, 20th of July 2022, 8:30 to 10 o'clock. So let me just give you the link. All right, let me just give you the link to register for tomorrow's sessions, which is we'll talk about money management and position sizing strategies to maximize stock returns. All right, so with that, I want to thank all of you here for tuning into this session. Hope you all enjoyed the session today. And if you can, if given opportunity, do explore what are ETF and watch out for the incentive given out by Bursa shortly on their social media account on how you can, what kind of incentive you can get from buying and selling ETF on Bursa Malaysia market. With that, thank you everybody and have a pleasant rest of the day. Bye everyone.